Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from Toronto at Consensus2025 by CoinDesk. And joining us for this segment, no stranger to the show, Sergey Nazarov. He's the co-founder of Chainlink. We're here to discuss how traditional financial institutions can securely and efficiently enter the blockchain industry and how that's going to help advance the future of financial institutions in general. It is great to see you as always. Sergey, big announcements that you have. I mean, you've been able to over $20 trillion in transaction value for financial institutions, startups, and developers worldwide. Taking it a step further with Chainlink's announcement that you're working with JP Morgan and Ondo Finance. What's the significance of that?
Yeah. Thank you for having me. Great to be back here with you. With JP Morgan and Ondo, I think there's a few significant things that happened. First of all, JP Morgan opened up its infrastructure for the first time and allows the payment side of a transaction to happen in its infrastructure, so the cash settlement, and then the asset side happens in Ondo, a public chain. So the second significant thing is that this is a transaction between a private institutional chain and a public chain. And then the third thing that's significant is that we were able to build this using something called the Chainlink runtime environment, the CRE. It's one of the first things that's going to be running on top of it, in addition to some of our work with Swift and others. And so we were able to build this really securely and efficiently using the CRE model, which means that it's all running on like a single system, a single piece of code across multiple other chains and systems and pieces of data. So I think it's actually a very big milestone for JP Morgan, for Ondo, for the industry, and for Chainlink.
Of course. How can CRE help traditional financial institutions securely and efficiently enter into the blockchain space?
Institutional transactions on blockchains are much more complex than public chain DeFi transactions because institutions have all these compliance requirements, accounting requirements, risk management requirements. They have a lot of legacy systems. They have a lot of data sources. They have a lot of identity systems. All of those systems and requirements need to be woven into a transaction. So a transaction within the public chain world of DeFi or just basic token ownership can be anywhere from 2 to 5 steps. But in capital markets, it'll be well beyond 10 to 20 steps for the transaction to actually happen. So what the CRE does is it provides a single environment where you can write a single piece of code to manage all of that complexity. Manage the interaction with data sources, multiple chains, multiple identity sources, multiple compliance requirements. And that's what we use in the JP Morgan transaction. And I think that's what we will be using in a lot of the future institutional work, because it takes all of this complexity around compliance and data and identity and multiple chains, and it basically turns it into a single piece of code that securely and reliably and provably runs in a single place, which is kind of the design pattern that you've actually seen in the past for capital markets, that once something like that becomes possible, their speed of iterating and their speed of launching new products massively accelerates. So in the 70s, Cobalt did this for the financial markets. In the 90s, Java did this for the financial markets. And now in this blockchain-based Web3 financial system, we think that Chainlink and the Chainlink runtime environment will do it for the financial markets.
Especially when you have compliance by design in there as well. So you've been spending some time in Washington, D.C. with a number of government representatives. What are some of your takeaways from that?
I think that the pendulum has swung completely in the other direction. So it's a 180-degree turn from where it was before. Things were very negative before, and now they're extremely positive. So it didn't go from negative to neutral. It went from negative to positive. And everybody at the most senior levels, at the top regulators, at the Treasury, at the executive branch, in the Congress, are all now looking to push the idea that the U.S. is a leader in cryptocurrencies. The U.S. is a leader in real-world assets and digital assets, and we're working with many congressmen, senators, different agencies in D.C. to try and make sure that they understand what that looks like when it works well, and to enable our industry to grow through clear rulemaking, clear guidance, clear legislation, legislation that will enable DeFi to succeed, legislation that will enable institutions to go on chain and tokenize more funds, make their own stable coins, do all of these kind of critical activities.
Yeah. Why is proof of reserve critical to the future of financial market infrastructure?
Proof of reserves takes the problem of auditing and it automates it. And if you look at much of the fraud and the failures in the financial market, anywhere from Enron onto failures like Silicon Valley Bank, Bernie Madoff, FTX, all of these failures, just the ones that I mentioned, are US based, there are many others globally, are basically issues with audits and issues with understanding what the underlying assets are and what state they're in. And those issues can be resolved if you can automate the verification and the auditing of the assets. And that's what proof of reserves, proof of composition, proof of solvency, all these proof of mechanisms are basically a way to define an automated near real-time audit. So the audit cycle goes from a year or a quarter down to a second. And you really can't, in my opinion, commit too much fraud in a second. In a year, like Bernie Madoff had 20 years.
Yeah.
FTX had the period it had, which was, depending on who you talk to, a year to 2 years. Silicon Valley Bank, it wasn't exactly fraud, but there was dislocation of market expectations. So if you close that gap by making auditing automated and pretty much real time, you solve a really fundamental problem in financial markets.
It's going to change your risk management model
Completely.
entirely.
Yeah. That's right.
So when you look forward to 2025 and you're looking towards 2026, what's your vision for Chainlink?
I think we see a world where the institutional side of the market has gone on chain. It needs the ability to reliably generate tokenized funds, stable coins. It needs the ability to have those tokenized funds and stable coins transact, similar to what we've done with JP Morgan and Ondo that you mentioned. Except now you have thousands of times more of that, right? And you have all kinds of different funds, tokenized commodities, tokenized equities, tokenized all financial products that you can imagine. The derivatives industry, I think, also goes on chain. And all of these financial products are interacting with each other across multiple chains through a cross-chain system like CCIP. They're meeting compliance requirements through the Chainlink data feeds and compliance layer. And all of this is being coordinated and orchestrated in a way where it's low cost for banks and asset managers to generate more assets, do more transactions. And so you have this kind of virtuous cycle of more assets, more payment methods transacting.
Right.
And that virtuous cycle shows volume and it shows growth, which just attracts more and more of the institutional world. I do believe that retail demand for Bitcoin and these other things will continue, and that'll also grow the market.
Right.
But in my opinion, the institutional inflow of capital
Right.
will outpace the retail demand for cryptocurrencies. And at that point, our industry will really become more so about what is now called real world assets or digital assets.
Yeah.
But just like the internet was at a certain point about email and then eventually became about many other things, I think our industry is kind of at that moment where it's going to go from being about cryptocurrencies to basically being about all these different types of asset classes on chain. And those asset classes on chain will eclipse the total value of cryptocurrencies.
That's something that we spoke about last year when you were on the show, is that's going to be your source of liquidity.
That's right.
If you want to participate in that pool, these assets are going to have to be tokenized.
Right. That's the new liquidity. Like
Right.
this industry grows on the basis of net new capital flowing in.
Right.
And that's where all the net new capital, or the vast majority of the net new capital, in my opinion, at this stage of the industry's development will come from. And to have that capital come in, you need to solve these complex transactional problems around data, identity, interoperability, integration with traditional legacy systems, because all of those participants have those systems. And you need to make that simple and efficient and secure. And if you can do that, then if the barrier to entry, if the cost of generating those assets drops low enough, then I think you have this kind of inflection point where everyone just starts doing it because it's a good economic proposition.
Well, Sergey, appreciate the insight as always. Thanks for joining us on
Thank you.
Trade Talks. And thanks for joining me from Consensus. I'm Jill Malandrino, Global Market Reporter at Nasdaq.